The goal of this course is to teach you bookkeeping both quickly and effectively. By the end of it, you'll be able to confidently do the bookkeeping in your business, have a professional understanding of bookkeeping, and with that professional understanding, be able to breeze through most, if not all, bookkeeping certification programs, if that's what you want to do. This course is designed for small business owners, but if you don't own a small business and you just want to learn, you're in the right place as well. So with all that said, welcome to Bookkeeping for Small Business Owners, a crash course in bookkeeping. As a quick introduction, my name is Christian. I'm the owner and chief bookkeeper of Vitality Bookkeeping. I have 2 accounting degrees. I'm certified with Intuit as a trained bookkeeper and a QuickBooks Online Pro Advisor, and I'm actively working with a number of clients as their bookkeeper. If you want my full backstory and credentials, you can find them on my website, vitalitybookkeeping.net. Likewise, if you want your books taken care of, I'd be happy to do them for you so you can focus on the real work in your business. Once again, if you're interested, go to vitalitybookkeeping.net. All right. This course is going to be structured like a pyramid, where we'll start at the very bottom with the fundamentals and then build our way up until you have a complete understanding of bookkeeping. I'll be doing this in a way that's very simplified and practical, as opposed to the long technical descriptions. I'm going to make it so that it's going to be simple and easy to understand. And likewise, I'm going to be using a lot of real-world examples so you can apply the lessons as you learn them. And most notably, though, repetition is a very effective way of learning, so I'm going to be using a lot of repetition as well. And one more thing while we're at it, this course will be focused on cash basis accounting. Don't worry if you don't know what that is yet. We'll definitely get into that later. For now, just know that cash basis accounting is the most common method of bookkeeping and is used by close to 80% of small businesses. It's overwhelmingly likely that you're using cash basis. But if you want to double check, go to your tax return and near the top, it'll say the words cash or accrual, one of those two. You'll learn a lot from this course either way, but it is focused on cash basis. And if you are accrual, you'll still learn, but be sure to brush up on the differences. All right, with all of that said, today we'll be starting at the very bottom of the pyramid, answering the questions, what is bookkeeping? What does a bookkeeper do? And then, why do businesses even need bookkeeping to begin with? After that, we will go into some of the more boring sounding items, those being the 4 ethics of bookkeeping and the 10 accounting principles. And although they do sound boring, they are very important, and they form the foundation for all the bookkeeping you'll be doing in the future. That said, though, don't worry. You don't need to learn them all at once. I just want you to become familiar with them, and I want you to use either this video or your own notes as a sort of reference for them in the future. So let's get started with today's lesson. What is bookkeeping? Well, lucky for us, bookkeeping describes itself. Simply put, bookkeeping is keeping the books. The books, which is something we'll touch on later, are used to organize all of the transactions in a business. A much easier definition, though, and the one I actually want you to learn, is this. Bookkeeping is keeping track of how money flows through a business. It's keeping track of when money comes into your business, when you receive cash from things like performing a service or selling inventory. It's keeping track of when money goes out of your business through things like buying supplies or paying off loans. It's also keeping track of when money moves within your business, such as when you transfer money between your checking and savings accounts. In short, bookkeeping is making sure every penny in a business is accounted for. Or, once again, it's keeping track of how money flows through a business. If you want a practical description, bookkeeping is looking at the transactions a business has for a given period of time and then properly recording those transactions so they can be used to create valuable information. We'll cover all of that throughout the course, but for now, I just want you to remember that bookkeeping is keeping track of how money flows through a business. This, of course, brings up the question, how is bookkeeping different from accounting? Technically speaking, bookkeeping is actually one part of accounting. We'll cover this more in a later video, but for now you can think of it like this. Bookkeeping is writing things down, and accounting is analyzing what's been written down. This leads to the next question then. What does a bookkeeper do? As you might imagine, a bookkeeper is the person who keeps track of how money flows through a business. More specifically, they do this by going through what I call the bookkeeping cycle. Don't worry if none of the following makes sense right now. I'll cover it properly in the future, but the idea is this. Bookkeeping cycle is an unofficial term to describe the bookkeeping part of the accounting cycle. The bookkeeping cycle typically happens on a monthly basis and goes as follows. And once again, if none of this makes sense, we'll be going over it. I just want to introduce it. All right. It goes as follows. Step 1, you categorize every transaction. Step 2, you reconcile every account. And then step 3, you create the financial statements. The bookkeeping cycle is done on a monthly basis, but it's also done on a quarterly and yearly basis as well, particularly for tax purposes. So, what does a bookkeeper do? A bookkeeper keeps track of how money flows through a business by following the bookkeeping cycle. which of course is something we'll talk about later. Now, why do businesses need bookkeeping? There are plenty of high value reasons to do bookkeeping, of course, including things like knowing your cash flow, knowing what's profitable, knowing what isn't profitable, getting access to loans, making decisions, and so forth. The most important reason, though, is legal compliance. Businesses need accurate books in order to pay taxes properly and to show that they're complying with regulations. So why does a business need bookkeeping? Legal compliance. All that said, let's use an analogy to put everything together. Imagine your business as a warehouse, and every dollar in your business as a package. Every time a package enters the warehouse, a worker scans the package and records the information. Likewise, every time a package leaves the warehouse, a worker scans it and gathers the information. This makes it so that despite a seemingly endless number of packages, everything is organized and up to date. The owner of the warehouse is able to stay legally compliant while having all the information they need to make important decisions. This is the essence of bookkeeping. However, instead of scanning packages as they enter and leave a warehouse, a bookkeeper organizes money as it travels through the business. So, let's do a quick recap. I encourage you to pause and answer before I do. And don't worry about wording this perfectly, just make sure you know the core idea. So first, what is bookkeeping? Bookkeeping is keeping track of how money flows through a business. Second, what does a bookkeeper do? Bookkeepers keep track of how money flows through a business by following the bookkeeping cycle. And then third, why do businesses need bookkeeping? Businesses need bookkeeping to be compliant with the law. Now, let's round out the foundations of bookkeeping by going over bookkeeping ethics and the principles of accounting. And just real quick, if there are any terms that don't make sense, for example, the word financial statements, I don't expect you to know what financial statements are yet. If there are any terms you don't understand, just know that I'm very likely going to cover them in the future, and for now, they should make sense in the context they're in. So let's start with the ethics of bookkeeping. The ethics of bookkeeping can be summarized into 4 core points, and as a total, they are the moral guidelines that all bookkeepers need to follow. In no particular order, these are ethic number 1, honesty. Bookkeepers must always be honest in their work. This one's pretty straightforward, but it means things like reporting numbers correctly, not concealing information, and owning up to any mistakes. For example, let's say you accidentally turned a $10 transaction into a $100 transaction. Honesty would be seeing, whoops, I accidentally added a 0, and then removing the 0 and correcting your mistake. Ethic number 2, objectivity. Objectivity means not letting feelings or any kind of outside influence affect your bookkeeping. In other words, things like avoiding conflict of interest, never twisting the numbers, never mixing business transactions with personal transactions, and of course, always complying with the accounting principles, which we'll learn in a minute. An example of objectivity would be having the opportunity to tweak a number to get a loan and deciding, nope, I'm going to stay objective and I'm going to leave the numbers the way they are. Ethic number 3, confidentiality. Confidentiality simply means keeping private information private. As you know, financial information is very sensitive, and so a bookkeeper must keep that information under wraps. As a business owner, you have more leeway as to what you want to share and what you don't want to share, but generally the principle is this. You never talk about your client outside of the job, and you never use a client's information for personal gain. For example, if you work with a local business and someone walks in and asks, hey, how much are you guys spending between each other? Confidentiality would be declining to answer that question. Ethic number 4, professionalism. Bookkeepers must always act professionally. That means being respectful to those you work with and being able to actually do the job that you were hired for or you're charged with. Studying this course is an example of professionalism because you're doing what you need to do to keep your business operational. And in this case, that's gaining a strong understanding of bookkeeping. And with that said, those are the 4 core ethics of bookkeeping. It went pretty fast because it's pretty straightforward. So let's just do a quick quiz to recap and make sure we're all on the same page. And once again, I encourage you to pause and try to answer the question yourself before I give the answer. So, what are the 4 ethics of bookkeeping, and what does each one mean? Ethic number 1 is honesty. Honesty means always be honest. Ethic number 2 is objectivity. Objectivity means don't let emotions or outside forces influence your bookkeeping. Ethic number 3 is confidentiality. Confidentiality means keeping private information private. And ethic number 4, professionalism, means always act professionally. Once again, there's no particular order here, and in all likelihood, you've probably already been living by these ethics your entire life to begin with. But nonetheless, it's important to go over them just to give you a comprehensive understanding of what's required for bookkeeping. Now, let's wrap up today's foundational episode with the 10 principles of accounting. First, the whole reason accounting principles exist is so that businesses have a standardized way to report their financial information. In essence, these principles translate any business into a universally understandable language. More relevant to this course, though, bookkeeping must obey these principles or be considered invalid. Don't worry though, most of these are common sense and things you would already be doing naturally as a business owner. As mentioned before, these are for cash basis. Accrual basis accounting has a few more, which we won't cover here for the sake of relevancy. Also, there's no particular order, and I don't expect you, once again, to learn them all this episode. I just want you to become familiar with them and to become aware of them. Principle number 1 is the economic entity assumption. This means that, for accounting purposes, a business is considered its own separate entity, different from its owner or any other business. In other words, money that's in the business belongs to the business and not the owner. A business is its own thing. Practically speaking, this means keeping your personal finances separate from your business finances. For example, if you buy groceries with your business card, which you shouldn't do, that wouldn't be considered a business expense. It would be considered a withdrawal from your business for a personal expense. This principle is important because if the business wasn't its own separate entity, there would be no way of figuring out what financial condition the business is in. Everything from taxes to decision making would be completely thrown off. As an example of this principle, let's assume Abby owns Abby's Bakery. If Abby buys several pounds of cookie dough to make cookies to sell, the money she spent on the cookie dough would come from the business, and the money she earns from the cookie dough would go back to the business, not to her. That separation is the economic entity assumption in a nutshell. You quite literally assume a business is its own economic entity. Principle number 2, the reliability principle. Transactions need evidence. Simply put, you need proof before you can record a transaction. As we know from earlier, bookkeeping is keeping track of how money flows through a business. We'll dive deeper into this later, but for now, you need to know that the way bookkeepers track this flow is by recording transactions. The reliability principle states that the only transactions you're allowed to record are transactions that can be proven with evidence. That means you need a receipt, a bank entry, really any type of documentation. If there's no documentation, though, it can't be recorded. For example, if you pay someone in cash for their old office supplies and they don't give you a receipt, then you can't record that transaction and you can't write it off. This is important because if evidence wasn't required, then anybody could make up anything they wanted about their business, which would lead to some inaccuracies to say the least. For another example, let's say Abby from earlier wants to record one of her expenses. She thinks it was $45, but she threw away the receipt and doesn't have any other sort of documentation. Unfortunately, Abby would not be able to record this as an expense. To obey the reliability principle, transactions must have evidence. Principle number 3, the materiality principle. The materiality principle states, details that are too small to affect financial statements can be ignored. For example, if your business makes $100,000 in a year, then you can round up all pennies to the nearest dollar. This principle is extremely subjective though, and honestly, if you're doing your own bookkeeping, I recommend making sure everything is penny for penny accurate. That, or at least consult a CPA before determining what's material and what isn't. That said, the materiality principle is important because by being able to ignore immaterial amounts, accountants and bookkeepers are able to collectively save countless hours of time. Principle number 4, the full disclosure principle. The full disclosure principle states that if there's information about your business that will materially affect the financial statements, that information must be reported in what's called the notes to the financial statements. For example, if an employee sues a business for $1 million, but the case hasn't gone to court yet, that pending lawsuit needs to be noted with the financial statements. The full disclosure principle is important because not everything that affects the health of a business will be in the numbers themselves, and the people looking at the financial statements need to know what condition the business is in. Principle number 5, the conservatism principle. The conservatism principle states that if you're not sure, choose the least optimistic option. In other words, always err on the side of caution. For example, if we look at the lawsuit from the full disclosure principle example, after we've disclosed the lawsuit, if the business is likely to lose and that loss amount can be calculated, the conservatism principle states that the least optimistic of these equally likely outcomes should be recorded. Vice versa, if the business is suing somebody for a gain, they cannot record that gain until victory is either certain or it's already won, such as after a court order. In other words, you record likely losses, but you don't record likely gains. The conservatism principle is important because, by erring on the side of caution, it creates a much more honest and reliable picture of what state the business is in. Principle number 6, the consistency principle. The consistency principle states that once you start using an accounting method, you need to stick with that method. It's acceptable to switch methods only when that switch is both well documented and would improve your financial statements. I mentioned cash basis accounting near the beginning of the video. The consistency principle states that if you use cash basis accounting, you need to record everything under cash basis. That is, of course, unless you decide to switch to accrual, which would need to be well documented and also be an improvement. For example, if Abby does her bookkeeping under cash basis, she can't start suddenly doing it under accrual basis partway through the year. She would need to consult her CPA and go through the correct process. The consistency principle is important because it allows a business to compare itself over time. If accounting is done one way in one period and a different way in the next period, it can be challenging to understand how the business has changed and may lead to material problems. Principle number 7, the going concern principle. The going concern principle means that you should always assume a business will stay open unless there's significant evidence otherwise. This means recording transactions over their appropriate time period unless the business starts feeling shaky. For example, let's say Abby buys a new oven for her bakery. She would record the transaction under the assumption it will be used for her business for the foreseeable future. If auditors or management note that a business is on shaky footing, then they will have that note in the financial statements, and if a breaking point is reached and it's time to go out of business, the business will shift from going concern to liquidation. The going concern principle is important because it ensures financial reporting matches the economic reality of the business, which is that businesses expect to exist for the foreseeable future. And one last thing, foreseeable future means a 12-month period, typically speaking. Principle number 8, the monetary unit assumption. The monetary unit assumption states that all financial reports must be done with a single, stable currency. For example, in the United States, financial reports must be done with the US dollar. If a US business wants to track their books with a separate currency, that's fine, but they must convert those amounts back to the US dollar for official submission in the United States. Also, most currencies, including the US dollar, experience inflation. For the sake of consistency, the principle requires that we ignore inflation in the United States, except for cases of hyperinflation, which will be made obvious. The monetary unit assumption is important because by using a single currency, financial statements become simple to create and understand. Likewise, using one currency ensures everyone reads and understands the financial information in the same way. Principle number 9, the cost principle. The cost principle states that assets should be recorded at the amount you paid for them, without ever adjusting for market value. In other words, when your business buys something, the cost of that thing becomes the official value in the books, even if the market value changes. For example, if you pay $200,000 for a building and the market value is $250,000, you would still record the building as being worth $200,000 in your bookkeeping. The cost principle is important because it keeps things objective. Market values change all the time and can be highly subjective. By sticking to the original cost, your books are based on actual, verifiable transactions. Principle number 10, the time period principle. The time period principle states that a business's financial activities can and should be reported in shorter chunks of time, such as monthly, quarterly, and annually. For example, if you heard a business earned $100,000 over a 2-year period, it would be useful, but a lot of context is missing. The time period principle makes it so you can break down those earnings into smaller windows of time to get a better idea of what actually happened, such as what happened in what quarter. This principle is important because it allows those interested in a business, such as debt holders and investors, to clearly understand how the business operates over time. And that's it. Those are the 10 principles of accounting. It was a lot to cover at once, and we happened to do it all very quickly. So it's totally normal if you don't understand everything yet. The main point, like I said, was to get yourself familiar with these things so that we can get started on the real bookkeeping next episode. For now, let's do a quick recap quiz to make sure we're on the same page. Once again, I encourage you to pause and try to answer before I do. And don't worry if you don't get the words exactly right, just try to recall the essence of what we went over. Also, since it was a lot at once, and we're not going to spend a lot of time on these, for this quiz, I will give you the name of the principle, and I just want you to try and remember the definition. All right, let's get started. Number 1, what is the economic entity assumption? For accounting purposes, businesses are considered their own separate entity. Number 2, what is the reliability principle? Reliability principle states that transactions need evidence. Number 3, what is the materiality principle? Details that are too small to affect the financial statements can be ignored. Number 4. What is the full disclosure principle? Material financial information must be disclosed. Number 5. What is the conservatism principle? If you're not sure, choose the least optimistic option, or err on the side of caution. Number 6. What is the consistency principle? Once you choose a method, stick with it. Number 7. What is the going concern principle? Assume a business will stay open unless there's significant evidence otherwise. Number 8. What is the monetary unit assumption? All financial reports must be done with a single stable currency. Number 9. What is the cost principle? You must record assets at the amount they were paid for. And number 10. What is the time period principle? A business's financial activities can and should be reported in shorter chunks of time. All right, that was the first episode of Bookkeeping for Small Business Owners. We went over a few introduction questions, the 4 ethics of bookkeeping, and of course, the 10 accounting principles. Next episode, we'll actually start learning how to do bookkeeping, focusing on transactions and the accounting equation. If you have anything on your mind or you have any questions, please leave a comment. If you're interested in getting your bookkeeping taken care of, please visit vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you in episode 2. Welcome to episode 2 of Bookkeeping for Small Business Owners. Today, you'll learn 2 of the most important concepts in bookkeeping. These are transactions and the accounting equation. These are crucial for actually doing bookkeeping, and the better you understand them, the better you'll be at bookkeeping. They also round out the foundation of our pyramid of knowledge. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. All right. In episode 1, you learn the ethics of bookkeeping as well as the 10 accounting principles. Now we're going to start digging into how to actually do the bookkeeping itself. As we learned, bookkeeping is keeping track of how money flows through a business. The way this is done, though, is by recording transactions. What does that mean? Every time money enters or leaves a business, that event is written down. These events are called transactions. Transactions include everything from sales to purchases to loans to truly any situation where money flows through a business. Whenever a transaction happens, there are details that need to be recorded. These explain what the transaction is, including things like the date, the amount, who was involved, what accounts were affected, and so forth. We'll cover this fully in a later episode. Bookkeeping, or tracking how money flows through a business, is done first by recording transactions, which is looking at a transaction and writing down the details. Now, you might ask, how do I record transactions properly? That's where the next part of our bookkeeping pyramid of knowledge comes into play. Let's start with one of the most important concepts in bookkeeping, the accounting equation. If bookkeeping is keeping track of how money flows through a business, and this is done by recording transactions, then the first step in recording a transaction is plugging it into the accounting equation. I cannot emphasize enough just how critical this equation is. I'll put it this way. If you know how to plug transactions into the accounting equation, you can cut the time you spend on bookkeeping by, I feel like 90% would be a reasonable number. So, the accounting equation. The accounting equation is this. Assets equal liabilities plus owner's equity. Let's break that down. Assets are what a business owns. These are things like cash in business accounts, buildings in the business's name, inventory, and so forth. Liabilities are what a business owes. These are things like loans, unpaid bills, and taxes. Owner's equity is what the owner owns. Think of this like the owner's stake in the business. What the owner has claim to, in other words. Owner's equity is everything left to the owner after all the liabilities are paid. Owner's equity increases with things like owner investments and net income. Why is what the business owns different from what the owner of the business owns? Remember the economic entity assumption. For accounting purposes, businesses are considered their own separate entity. So, assets equal liabilities plus owner's equity. In other words, what a business owns is equal to the combined value of what it owes and what the owner owns. Together, all possible transactions in bookkeeping fit into one of these 3 categories, those being assets, liabilities, and owner's equity. I just want to reiterate, every transaction fits into one of those 3. That's why it is such an important concept to learn the accounting equation. And as a quick clarification, there are 2 additional categories called revenues and expenses, but they're subcategories of owner's equity. So in other words, they're owner's equity, they're just categorized a little more specifically within owner's equity. We'll cover those later. For now, just focus on the main three: assets, liabilities, owner's equity. And of course, the equation is assets equals liabilities plus owner's equity. All right, another way of thinking about the accounting equation is this. Since the business isn't a person, what the business owns has to go to somebody eventually. The left-hand side of the equation is what's up for grabs, and the right-hand side of the equation is the breakdown of who's entitled to what's up for grabs. Remember, bookkeeping is keeping track of how money flows through a business. This is done by recording transactions. And the first step in recording a transaction is plugging it into the accounting equation. So now we get to the fun part. Let's look at 5 transactions and plug them into the accounting equation together. In other words, let's actually do some bookkeeping. At least the first step. First though, let me acknowledge that this is just scratching the surface, and it's totally normal if everything is still a little confusing. Ideally, things will start to make sense as we go through these examples. That said, let's start plugging things in. Transaction number 1. Vinny opens a business and transfers $500 from his personal account to the business's bank account. How does this plug into the equation? First, let's recall the 3 options. Assets, what the business owns; liabilities, what the business owes; and owner's equity, what the owner owns. Let's go step by step. Assets. Is this something the business owns? Yes. The business now owns $500 in cash. Liabilities. Is this something the business owes? No. There's no indication that Vinny expects his money to be repaid. Owner's equity. Is this something the owner owns? Yes. By not expecting to be repaid, Vinny putting $500 into the business is considered an investment. He now has claim to $500 of the business's assets. Final result, $500 in assets equals $0 in liabilities plus $500 in owner's equity. The equation is balanced. I want to emphasize that for every transaction, the accounting equation must balance. The 2 sides must be equal. Assets must equal liabilities plus owner's equity. I know the fact that it's an equation already implies this, but it can be easy to forget when you're first learning. Just remember, the accounting equation must always balance. Transaction number 2. Margaret wants to purchase a new building for her business. She gets a $100,000 business loan from the bank. Once again, let's go step by step. Assets. Is this something the business owns? Yes. The business has gained $100,000 in cash. Liabilities. Is this something the business owes? Yes. The bank explicitly loaned the money, expecting to get that money back in the future. Owner's equity. Is this something the owner owns? No. The money was loaned specifically to the business, not Margaret. Final result, $100,000 in assets equals $100,000 in liabilities plus $0 in owner's equity. At this point, you might be wondering where these transactions come from. Where do transactions come from? That is something we'll cover in episode 6, but for now, just imagine that you are the bookkeeper and these people are your clients, and that they are sending you physical receipts, or if they're not sending you physical receipts, then you are looking in their bank feeds and reading the transactions as they enter the bank feeds. Transaction number 3. Continuing from transaction number 2, Margaret uses the $100,000 in cash from the loan to purchase a new building for her business. Let's go step by step. Assets. Is this something the business owns? Yes. The business owns the new building. Margaret paid for it with the $100,000 in cash from the loan, bringing the cash asset to 0 and the building asset to $100,000 in value. Liabilities. Is this something the business owes? Yes. The cash was spent on the building, but the business still owes $100,000 to the bank. Owner's equity? No. If the loan and building purchase are the only transactions in the business, then oddly enough, Margaret would only own the business entity, but she wouldn't have claim to anything in the business itself. If there was a liquidation, for example, the building would be used to pay off the debt, and Margaret would be left with $0 in value, as she only has $0 in equity, which is a claim of $0 in assets. Final result, $100,000 in assets equals $100,000 in liabilities plus $0 in owner's equity. Let's round out our introduction with 2 common transactions that don't fit obviously into the accounting equation. Transaction number 4. Cookies Galore sells a tray of cookies to a customer for $8 in cash. Step by step. Assets. Is this something the business owns? Yes. The business earned $8 by selling the cookies. They now have $8 in cash. Liabilities. Is this something the business owes? No. The customer got the cookies they paid for. Owner's equity. Is this something the owner owns? Yes. The $8 earned from selling the tray of cookies is considered a type of owner's equity called revenue. In just a moment, I'll explain. Let's finish the problem first. Final result, $8 in assets equals $0 in liabilities plus $8 in owner's equity. All right, it's finally time to learn about revenues and expenses. Then we'll apply that learning to transaction number 5. So, what is revenue? Revenue is money the business earns. It's the money gained in exchange for goods or services, like selling cookies, landscaping, really any good or service you can think of. What are expenses? Expenses are the money a business spends to operate the business. This is the money that's used so the business can run, like when purchasing inventory, paying employees, and really anything that's ordinary and necessary for running a business. Remember, the accounting equation must always balance. For every dollar in the business, someone must have claim to that dollar. As we know from the accounting equation, assets equal liabilities plus owner's equity. When a business earns money, they earn an asset. Since the asset was earned without an expectation of repayment, that asset cannot be a liability. Therefore, the owner is the only entity that can claim this newfound asset. This is why revenue is always considered owner's equity, because only the owner has a rightful claim to it at the time of transaction. A little complex, yes, but all you need to take away from it is this. In the accounting equation, assets equal liabilities plus owner's equity. Revenue will always fall under owner's equity. Expenses also always fall under owner's equity. If revenues increase that wealth that belongs to the owner, expenses decrease the wealth that belongs to the owner. We'll go substantially more in depth on these categories and how to differentiate them in the future. For now, let's go over transaction number 5. Transaction number 5. Cookies Galore spends $20 on flyers to advertise an upcoming sale. Step by step. Assets. Is this something the business owns? No. Wait. Don't they own $20 worth of flyers? Technically, they do own the physical flyers, but this brings up an important question in bookkeeping. If a business appears to own something, how do you know whether it's an expense or something they actually own, an asset? We'll discuss this more later, but for now, let's briefly introduce it to round out the accounting equation. So, if assets are what a business owns, and Cookies Galore seems to own $20 in physical flyers, then why are these flyers considered an expense and not an asset? Expenses happen when something is used up so quickly that it might as well come directly out of the owner's pocket. The important phrase to remember here is lasting value. Expenses are things the business spends money on that don't have lasting value. And assets are things the business spends money on that do have lasting value. Think about it like this. Assets equal lasting value. Expenses equal no lasting value. There isn't a hard and fast law for lasting value, but the general rule of thumb is this. If it's used up in the short term, usually days to months, then it's an expense and doesn't have lasting value. If it's used up over the long term, usually a year or longer, then it does have lasting value and it's an asset. So, what about the flyers? The business physically owns $20 in flyers, but the flyers don't have lasting value. This is because they'll be handed out soon for an upcoming sale. Cookies Galore is paying to promote something now, not paying for an ongoing asset. That's why this is an expense and not an asset. Now, let's use this information to fill out the transaction. Assets. Is this something the business owns? The flyers are for advertising and don't have lasting value, so the flyers are not an asset. So in that regard, no. That said, this is kind of a trick question, because the $20 they spend is an asset. So, is this something the business owns? Yes, but not referring to the flyers, referring to the cash. Liabilities. Is this something the business owes? No. They've paid for the flyers in full. Owner's equity. Is this something the owner owns? Yes. The flyers don't have lasting value and are thus an expense, which reduces the owner's income. Final result, negative $20 in assets equals $0 in liabilities minus $20 in owner's equity. So just to explain what happened there, Cookies Galore spent $20 in cash, an asset, to pay for the flyers, which are an expense, because the flyers don't have lasting value. This is why the end equation is negative on both sides, because they spent $20 on something that reduced owner's equity. Alright, I threw a lot at you at once. Let's review the key points. 1. Recording transactions is how a bookkeeper tracks the flow of money in a business. The first step in recording a transaction is plugging it into the accounting equation. The accounting equation is assets equal liabilities plus owner's equity. Assets are what a business owns, liabilities are what a business owes, and owner's equity is what the owner owns. Revenues and expenses are forms of owner's equity. And lasting value is how you determine if something is an asset or an expense. In order to really hammer this home, we'll be doing plenty of exercises. But first, we need to learn how to actually write down what you've plugged in. And that'll be next episode, where we go over double entry bookkeeping, the chart of accounts, and T-charts. That said, if you have anything in your mind or any questions, leave a comment. If you're interested in getting your books taken care of, visit vitalitybookkeeping.net. Otherwise, I'll see you in episode 3. Welcome to episode 3 of Bookkeeping for Small Business Owners. Today, we're going to learn how to write down what you learned in episode 2. Specifically, we're going to learn double entry bookkeeping, the chart of accounts, and T-charts. On our pyramid of knowledge, this will take us through our early core knowledge layer. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. All right, let's jump right in, starting with double entry bookkeeping. Double entry bookkeeping is how we translate the accounting equation into our bookkeeping records. It takes what we plugged in step 1 and puts it into a universally understandable accounting language. So what is it? Double entry bookkeeping is the formal system used by bookkeepers to record transactions. It's a method of bookkeeping where each transaction must affect at least 2 accounts. The logic here is that whenever money moves, it doesn't just appear out of nowhere and it doesn't just disappear completely. There's always a beginning and always an end to each transaction. As opposed to other accounting methods, the purpose of double entry bookkeeping is to write down where the money comes from and where the money goes. In other words, to keep track of how money flows through a business, which, if you remember, is exactly what a bookkeeper does. Thus, why bookkeepers use double entry bookkeeping. In addition to giving us the full picture, double entry bookkeeping also acts as a fail-safe and catches mistakes before they happen. More on that in a moment. First, let's get some context. The process so far. Bookkeepers keep track of how money flows through a business. They do this by recording transactions. Step 1 in recording a transaction is plugging it into the accounting equation. Step 2 in recording a transaction is writing down step 1 using the double entry bookkeeping method. So now that you've been introduced to the concept of double entry bookkeeping, let's learn how to use it and how to apply it. Double entry bookkeeping consists of 3 components: accounts, debits, and credits. Let's break each of them down. Accounts. Accounts are the specific categories transactions are recorded into. Accounts are used to keep track of money balances in a business, and they're used to keep track of money balance changes over time. If you recall the accounting equation, assets equal liabilities plus owner's equity, you'll remember that all bookkeeping transactions fall into one of those 3 general categories. If these are the general categories, accounts are the specific subcategories of those general categories. Example in a moment. Accounts are important because they're the fundamental building blocks of bookkeeping. When you record a transaction, the money in that transaction must be labeled under its correct account. In other words, all money must be categorized into an account. This categorization is the core of bookkeeping. Tracking account balances over time is how the flow of money in a business is tracked over time. We'll go over the various accounts and how to determine an account when we cover the chart of accounts later. For now, let's do one example to introduce the concept. Transaction number 1. Cookies Galore sells $200 worth of cookies and is paid in cash. Step by step. First, we know from the accounting equation that the business gained $200 in cash and the owner gained $200 in sales revenue, which adds to the owner's equity. Thus, $200 in assets equals $0 in liabilities plus $200 in owner's equity. Next, we determine the accounts. How do we determine the accounts? First, we look at how the money flowed. In this case, the business received $200 in cash, as well as the business earned $200 in sales revenue. We see the money affected 2 areas. Thus, we have 2 accounts. What are these accounts? Typically, the name of the account comes from the business's unique chart of accounts, or from accounting tradition and common sense. Once again, we'll get to these soon. In short, you identify where the money flowed, and then find the best label for where it flowed. On a very surface level, though, these accounts would be Cookies Galore gained $200 in cash, so we would simply label that account as $200 in cash, a cash account. Cookies Galore gained $200 in revenue from a sale, we would label that account sales revenue. Written out, it looks like this. Cash, $200 increase. Sales revenue, $200 increase. Once again, we looked at the flow, where the money went, and then we gave our best honest idea of what we would call the account that money went into or out of. So, to recap, accounts are the specific categories used to record transactions, and their purpose is to keep track of how money balances change over time. In this example, we identified the cash account and the sales revenue account. And if you're lost at all, here's the full context for how we got here. First, we looked at a transaction. Then, we determined how the money in that transaction plugs into the accounting equation. And then, we gave a specific label to the money based on where the money belongs on the accounting equation. And we call this specific label an account. So, for example, we figured out there was $200 in assets, and that specific asset account was called cash. And we also figured out there was $200 in earned revenue, and we determined the specific name for that revenue account was sales revenue. And of course, sales revenue and revenue in general is a subcategory of owner's equity, which gives us the final result: $200 in assets equals $0 in liabilities plus $200 in owner's equity. And that breaks down into the accounts $200 in cash, an asset account, equals $0 in any liability accounts, plus a $200 increase in the sales revenue owner's equity account. We will, of course, go into depth on this in the chart of accounts section later in this video. That said, having touched on accounts, let's now cover the two aspects of double entry bookkeeping: debits and credits. This is hard to teach, so buckle in. Debit means left-hand side, and credit means right-hand side. That's it. Before I explain more, it's crucial to remember which side is which. This trips up so many new bookkeepers, so it's very important to remember debits are left, credits are right. When written down, debits are abbreviated DR, like doctor, and credits are abbreviated CR. An easy way to remember this, and to remember which side is which, is to remember Dr. Craig. When you visualize the name Dr. Craig, you'll easily see that the DR is on the left side and CR is on the right side. One more important thing to note: debits are always written before credits. Think of it like reading order: left before right, debits before credits. All right, now that you know debits are left and credits are right, you might be wondering, left and right of what? They're the left and right hand sides of none other than the accounting equation. Yes, when it comes to assets equal liabilities plus owner's equity, debits are the normal balance for asset accounts, and credits are the normal balance for liability and owner's equity accounts. It's important to note, expenses are debit accounts because they reduce owner's equity. More on that later. And with all of that said, you might be asking, what is a normal balance? As we know, accounts track money balances over time. An account's normal balance is simply whether that account increases with a debit or whether it increases with a credit. If an account has a debit normal balance, it's known as a debit account. If it has a credit normal balance, it's known as a credit account. As you might imagine, this lines up with the accounting equation. Assets are debit accounts, and liabilities and owner's equity are credit accounts. There is some nuance that we'll cover later. For now, though, just remember the normal balance tells us if the account increases with a debit or a credit. And just to recap, assets have a debit normal balance because they're the left hand of the equal sign in the accounting equation. And liabilities and owner's equity have credit normal balances because they're on the right side of the equal sign in the accounting equation. With that background covered, we can finally go over what debits and credits do. So, what do debits and credits do? Debits and credits are how bookkeepers change the money balance in an account. For debit accounts, debits increase them and credits decrease them, and vice versa for credit accounts, credits increase them and debits decrease them. We don't use the words addition and subtraction because when balancing an equation, those terms are inconsistent. So for example, if you had a debit account worth $100 and you want to subtract $30 from that, you wouldn't subtract $30, you would credit $30 from that account. And likewise, if you had a credit account with $50 in it and you want to subtract $20, you would debit $20 from that credit account. And vice versa, in that $100 debit account, if you wanted to increase it to $150, you would debit $50 into that debit account. And for the credit account, if you wanted to make that $50 $70, you would credit $20 to make it $70. And now that you've been introduced to debits and credits, let's go back to transaction 1 from earlier. Transaction 1. Cookies Galore sells $200 worth of cookies and is paid in cash. If you remember, we determined that this resulted in a $200 increase in the cash account and a $200 increase in the sales revenue account. We just learned that debits and credits are how you change the money balances in an account. So let's update the balances in the cash account and sales revenue account. First, let's identify where these accounts are at on the accounting equation. Cash is something the business owns, so it's an asset. Sales revenue increases the owner's claim, so it's owner's equity. Now that we've identified that cash is on the left-hand side and sales revenue is on the right-hand side, we know that debits are left and credits are right, so this means that the cash account is a debit account and sales revenue account is a credit account. To record this transaction, we need to increase the cash account by $200 and the sales revenue account by $200. Debits and credits change money balances in an account, so increase this account by using their normal balances. Therefore, we can finally officially record this transaction by debiting the cash account with $200 and crediting the sales revenue account with $200. If the cash and sales revenue accounts both started with a $0 balance, for example, then by debiting and crediting them in this way, we increase the cash balance from $0 to $200 and the sales revenue account from $0 to $200. And this final stage, debiting and crediting, is how professional bookkeepers look at every transaction. We look at a transaction and we immediately translate it into what the debits are and what the credits are. So for example, if Cookies Galore earned $200 in cash from sales, as a professional, you would immediately look at that and see debit $200 cash, credit $200 sales revenue. And getting you to that point will be the goal of next episode, episode 4. For now, let's review the process and how we got here. So, Cookies Galore received $200 in cash for selling cookies. Then we converted that to the accounting equation. $200 in assets equals $0 in liabilities plus $200 in owner's equity. And then we updated the accounts using double entry bookkeeping. Debit cash, $200, credit sales revenue, $200. The cash account and sales revenue account both increased their balances by $200. And the transaction, at least at this stage, is complete. Now, let's recap debits and credits. Debits are the left-hand side of the accounting equation. Credits are the right-hand side of the accounting equation. Debits and credits are used to change the money balances in an account. For debit accounts, debits increase the amount and credits decrease the amount. For credit accounts, credits increase the amount and debits decrease it. There's one last thing to go over. As we just recapped, when you get a transaction, you convert it into the accounting equation, and then from that, you convert it into debits and credits to update the accounts. What is implied here that I need to explicitly mention is this. Total debits must always equal total credits. Remember, debits being left and credits being right comes from the accounting equation. Assets are debit balances, and liabilities and owner's equity are credit balances. Therefore, assets equal liabilities plus owner's equity is the same as debits equal credits. One of the most valuable things about double entry bookkeeping is that it allows us to catch mistakes because we can easily compare how much is debited in total and how much is credited in total for a transaction. In the Cookies Galore example earlier, if you add up all the debit amounts in the transaction, you would get a total of $200, and if you add up all the credit amounts, you would get a total of $200, making the transaction balanced. If debits and credits are ever unequal, there's been a mistake and you need to review the transaction. And this example was easy to figure out because there's only one debit and one credit on either side. In future transactions, you might have things where there's 5 or 6 debits on one side, 7 or 8 credits on the other side, just these massive transactions. And what needs to happen is that when you add up all the debits from the transaction, all the credits from the transaction, that final amount needs to equal on both sides. Total debits must always equal total credits. So just to reiterate, it's only the total amounts that need to equal for each transaction. If Cookies Galore was paid $60 in cash, $140 in equipment, that would still be a balanced transaction because 60 plus 40 is 200, and of course they earned $200 in sales revenue. $200 debits equals $200 credits, of course, total. All right, now you're familiar with the 3 components of double entry bookkeeping: accounts, debits, and credits. With that, let's put the pieces of double entry bookkeeping together to get the full picture. Double entry bookkeeping is the formal system used by bookkeepers to record transactions. Double entry bookkeeping means every transaction must be recorded with 2 sides, a debit side and a credit side. For every transaction, total debits must equal total credits, no exceptions. That's it. If you want to put it in one sentence, every transaction has a debit side and a credit side, and these sides must be equal. Let's finish off transaction 1 by officially recording it with double entry bookkeeping. We left off by debiting cash for $200 and crediting sales revenue for $200. To complete the transaction under double entry bookkeeping, we must now make sure the total debits equal total credits. There's only one debit, $200 in cash, and one credit, $200 in sales revenue. Total debits equal $200 and total credits equal $200. With these being equal, we can now officially finish recording transaction number 1. So that brings up the question, where do we officially record a transaction? Where do we write it down? We'll answer that question in episode 5. For now, there are 2 more key concepts we first need to understand: the chart of accounts and T-charts. Earlier, we talked about accounts, which are specific categories used to record transactions, so we can track money balances. We just learned that debits and credits are how you change the balances in these accounts. Now, we need to know what those accounts are and how to organize them. This is where the chart of accounts comes in. The chart of accounts, as you might have guessed, is the master list of all accounts in a business. Think of it like a filing cabinet or a menu at a restaurant. The chart of accounts is made up of 5 categories. Every account falls under one of these 5 categories. These 5 categories are assets, liabilities, owner's equity, revenue, and expenses. Sounds familiar? That's because the chart of accounts is made up of the categories in the accounting equation. If you picture it like a filing cabinet, these are the 5 main folders. And the individual accounts go into one of these 5 folders. If you picture a menu, these are things like breakfast, lunch, dinner, and the individual accounts are the foods and drinks within those categories. So we have the chart of accounts in the 5 categories that make up the chart of accounts. Now, how do we determine what accounts go into the chart of accounts? So every business does have their own unique chart of accounts, but the secret is that a majority of those accounts are virtually the exact same between businesses. This is because the way money flows through a business is usually the same between businesses. That said, certain niches and industries do require special accounts, which are generally intuitive to figure out once you get to that point. For now, though, let's cover the main accounts for each category and fill out our chart of accounts. Assets. Under the assets section of the chart of accounts, as you might guess, are the accounts for what the business owns. Asset accounts break into 2 categories: current assets and fixed assets. Current assets are cash, or assets a business will convert into cash within 1 year. In cash-basis bookkeeping, the only current asset account you'll use is cash, although some may track inventory. So, common current asset accounts are cash, usually broken into specific types such as bank accounts, usually the bank name, the type, and the last few digits, such as Wells Fargo checking, 1234, Chase Savings, 4321, so forth, undeposited funds, or cash that hasn't been deposited yet, and petty cash, which is just cash that is readily available and easy to access. Inventory. Inventory might be the only other current asset you track under cash basis. But as I mentioned, you probably just want to track cash, and it's better to track inventory separately and then reconcile with your books at a later date. And if you do want to make the switch to tracking inventory in your books, I recommend talking with a CPA first, just to make sure everything's dialed in. Fixed assets, as you might have guessed, are assets that you expect to last more than a year. There is some nuance though. If the asset is less than $2,500, it can be expensed rather than made a fixed asset. The $2,500 limit is called the capitalization limit and can differ based on company policy. More on this later. That said, common fixed asset accounts are equipment. Equipment accounts usually track the value of things like machinery, furniture, computers, so forth. Usually with the name being something like equipment dash type of equipment, equipment dash office, equipment dash machinery. Vehicles. Similar to equipment, this account tracks vehicles used in a business. Land. Tracks land owned by the business. Buildings. Tracks buildings owned by the business. And those are your fixed asset accounts, generally speaking. Equipment, vehicles, land, and buildings. Assets are pretty sparse under cash basis, but to recap, asset accounts are broken into current and fixed assets. Current assets are cash, or assets that will be turned into cash within a year, and fixed assets are assets that will last longer than a year. The main asset accounts are cash, undeposited funds, petty cash, inventory, equipment, vehicles, land, and buildings. Liabilities. Liability accounts are accounts for what the business owes. Similar to assets, there are current liabilities and long-term liabilities. Current liabilities are liabilities due within the year, and long-term liabilities are liabilities due after a year. Under strict cash basis bookkeeping, you don't usually track many liabilities because you only record expenses when you pay for them. The main current liability accounts are accounts payable, also known as bills, credit cards payable, which is credit card debt, and payroll taxes payable, which are the payroll taxes the business owes. Long-term liability accounts include mortgage payable, which is debt for property, and loans payable, which are loans. If we condense this down, the main liability accounts are accounts payable, credit cards payable, payroll taxes payable, mortgage payable, and loans payable. Owner's equity. Owner's equity, as you know, is the owner's claim to the business's assets. In a cash basis business, there are three main owner's equity accounts. Owner's capital. The owner's capital account tracks what the owner invests into the business, sometimes called owner's investment, shareholder capital, or partner capital, depending on the type of business and preference. Owner's draw. The owner's draw account is used when the owner withdraws money or assets from the business. And retained earnings. The retained earnings account is used to track a business's cumulative profit and loss. When you subtract expenses from revenue, the total goes into retained earnings. So for a quick summary, the three main owner's equity accounts are owner's capital, owner's draw, and retained earnings. Revenue. Revenue accounts cover the gross earnings of a business. The main accounts are sales revenue, which is money made from selling goods and products, service revenue, which is money made from providing services, interest income, money made from interest, usually from bank accounts or investments, and then miscellaneous income, which are just other sources of income such as rebates, one-time gains, so forth. Straightforward, the summary of revenue accounts is this: sales revenue, service revenue, interest income, and miscellaneous income. Expenses. Expenses are a convenient way to reduce the amount of taxes someone pays in their business. This is because, as you know, expenses directly subtract from revenue. As a result of reducing taxes, business owners do everything they can to find expenses. Not every purchase is a business expense, though, and expensing things that can't be expensed can lead to serious issues with the IRS. Teaching everything that can be expensed and everything that cannot be expensed is a massive undertaking and beyond the scope of this course. That said, a good rule of thumb is this: an expense is something both ordinary and necessary for operating a business. Ordinary means it's typical for that type of business, for example, coffee beans for a coffee store. And necessary means it's helpful and appropriate, even if it's not absolutely required. For example, marketing for a business. Once again, expenses are the ordinary and necessary costs of running a business. The main expense accounts are cost of goods sold. These are the costs directly tied to the goods you sell. These are the required costs for making the product. If you sell shirts for $20 and it costs you $10 to make them, that $10 would be considered the cost of goods sold. Rent expense. This includes equipment as well as the typical buildings and land that you might rent. Utilities expense, salaries and wages expense, payroll taxes. This is when you pay off the payroll taxes payable from earlier. It's important to note that income taxes are not an expense from your business. They're a personal expense, unless you're a C Corp, which is a very specific situation. So that said, payroll taxes are an exception, and you can write off payroll taxes as an expense. Marketing expenses, the cost of promoting your business. Supplies expense, cost of things like pencils, staplers. Professional fees, these are payments to people like lawyers, consultants, and bookkeepers. So yes, you can write off a bookkeeping expense. Travel expense, meals expense. Important to note about meals though, there are strict rules around meals to where on your taxes, you can only take 50% of what you spent on business meals as a deduction. Just keep that in mind. For your bookkeeping though, you record the full amount. It's just when you do your taxes later, you can only take half of that. Interest expense and insurance expense. And I know I read out every account for the other categories, but there are so many expense accounts that I'll spare you the monotony and not read them out. And with that, we round out the list of the most common accounts you might find in a business. Collectively, these accounts are known as the chart of accounts for the business and are organized based on where they land in the accounting equation. In fact, a common way of organizing the chart of accounts is labeling each account with a number. Assets starting in the 1000s, liabilities starting 2000s, owner's equity 3000s, revenues 4000s, and expenses 5000s. For example, cash might be labeled account number 1001, and supplies expense might be labeled something like 5015. This numbering system is totally arbitrary though. It's just how I do it personally and what I would recommend doing for your own business. All right, so far this episode, we have covered accounts, which are specific categories used to track money balances over time. Debits and credits, which are used to change the money balances in an account. Double entry bookkeeping, which is the official way transactions are recorded, which states every transaction has a debit and a credit side, and total debits must equal total credits. And now, chart of accounts, the master list of all accounts in a business. Let's finish off the episode by covering T-charts. T-charts are the visual representation of an account. They're used as a way to easily view the balance history of an account. You can think of looking at an account's T-chart like using a magnifying glass on the account. When written out, T-charts look like the letter T, with the account name on the top, debits on the left, credits on the right, and the net total at the bottom. Let's do 2 transactions to introduce the concept. And let's say before doing these transactions that Cookies Galore has this hypothetical, very basic chart of accounts. And we're going to go over transaction number 1 again so that we can view it through the lens of a T-chart. All right, transaction number 1. Cookies Galore sells several trays of cookies and earns $200 in cash. As we just learned, the purpose of a T-chart is to visualize what happens in an account. So let's use a T-chart to see how this transaction looks. First, we look at the cash T-chart. Notice the account name at the top, the debits on the left, the credits on the right, and the current total at the bottom. In this transaction, we debited cash $200. Therefore, we write $200 in the debit column. Once we've updated the account, we add total debits and total credits, then subtract from the normal balance. Once we've updated the accounts, we add total debits and total credits together, and then we subtract from the normal balance. The point of a T-chart is to be able to easily do this visually. In this case, we see $200 in debits and nothing in credits. Total debits $200, total credits $0. The normal balance for cash is debit, so we subtract credits from debits. $200 minus $0 equals a net total of $200 for the cash T-chart, or the cash account, in other words. Much quicker now, here's the sales revenue T-chart. We credited sales revenue $200, so we jot that down. Sales revenue increases owner's equity, so it increases the right-hand side of the equation and therefore has a credit normal balance. Therefore, we subtract debits from credits this time. $200 minus $0 equals a net total of $200 for the sales revenue account. After updating everything, Cookies Galore's chart of accounts would now look like this. Transaction number 2. Cookies Galore spends $30 in cash for kitchen supplies. Step by step. This decreases the cash account by $30 and increases the supplies expense account by $30. Cash is an asset, which decreases with a credit. Supplies expense is an expense, which increases with a debit. Wait a minute. Aren't expenses on the right-hand side of the accounting equation? Doesn't that mean they should increase with a credit? We have touched on this before, and this is the final point about debits and credits. And that is, it's true. Debits are left and credits are right. Assets are debits, and liabilities and owner's equity are credits. It may not be obvious, but expenses being debits actually follows this rule. Think of it like this. Debits decrease owner's equity. Expenses decrease owner's equity. Therefore, expenses must be debits. And expenses need to be in the owner's equity section because expenses directly reduce the owner's claim to the business's assets. If you remember, there are 3 main categories: assets, liabilities, owner's equity, and 2 subcategories, revenues and expenses, when it comes to accounting. Another way to remember which of those categories are debits and which of those categories are credits is the acronym DEALER, spelled D-E-A-L-E-R. The DEA is on the left-hand side of dealer and stands for draws, expenses, and assets, the 3 debit accounts. The LER is on the right-hand side of the word dealer and stands for liabilities, equity, and revenue, the 3 credit accounts. All of that being said, though, I much prefer you just remember the accounting equation, assets equal liabilities plus owner's equity, and you remember that on the left-hand side, things that add to the left-hand side are debits, things that take away from it are credits, and likewise, on the right-hand side, things that add to it are credits, things that take away from it are debits. And if we apply the acronym DEALER to that, draws take away from the right-hand side, so they're debits. Expenses take away from the right-hand side, so they're debits. And assets add to the left-hand side, so they're debits. And likewise, the LER, liabilities, add to the right-hand side, so they're credits. Equity adds to the right-hand side, so they're credits. And revenue adds to the right-hand side, so they're credits. So although you can use the word dealer to help remember, I do prefer that you just fundamentally learn the accounting equation itself. That said, let's go back to T-charts and back to transaction number 2. So, where we left off. Cookies Galore spent $30 in cash to buy kitchen supplies. We just recognized that this is a $30 decrease in the cash account and a $30 increase to the supplies expense account. Therefore, we debit supplies expense $30 and credit cash $30. We add up total debits, $30, and we add up total credits, $30, and see the total debits and total credits are equal. Therefore, the transaction is complete. Now, let's use T-charts to see how this transaction looks. First, we look at the cash T-chart. At the bottom, you see the current total is $200 from transaction number 1. We just credited cash $30, so we write that down. As a debit account, we subtract credits from debits. $200 minus $30 equals a net total of $170 for the cash account. You might be thinking, wait, shouldn't total credits equal total debits? That rule only applies to individual transactions and when you compare all the accounts in the business at the same time. So yes, in a single transaction, in the books overall, the totals must be equal. For each individual account, though, total debits do not need to equal total credits. In fact, most of the time, the normal balance will be higher than the opposite of the normal balance. If you have an account where the opposite is true, where the non-normal balance is higher than the normal balance, that's actually a red flag, and you should check that out to make sure that everything is correct in that account. And with that said, we see now that the cash account has a final total of $170 debit. Now let's look at the T-chart for supplies expense. We debited supplies expense $30, so we write that down. Expense accounts have a debit normal balance because they reduce owner's equity. Therefore, total debits, $30, minus total credits, $0, equals a net balance of $30 as a debit for the supplies expense account. Therefore, total debits, $30, minus total credits, $0, equals a net debit balance of $30 for the supplies expense account. Now, if you remember, here's what Cookies Galore's chart of accounts looked like before transaction number 2. Here's what it looks like now after updating from their second transaction. Without T-charts, we would simply see the name of an account, and then we'd watch the balance next to it change with each transaction. With T-charts, however, we can see the exact breakdown of how we arrived at each amount and each balance for that account. You don't need to use T-charts while doing your bookkeeping, but they can be helpful. Think of them like a tool for when you want to learn more about an account, or if you're trying to figure out a problem. This is how most bookkeepers use T-charts. All right, that's everything for this episode. To recap, we learned the following concepts and the nuances. Double entry bookkeeping, which includes accounts, debits, and credits. The chart of accounts, and T-charts. All right, everything we've learned so far is very conceptual, and it's time to solidify it. We have enough information to properly record transactions, so next episode will be an episode of nothing but practicing transactions. We'll be going over transactions that you haven't seen before, so I'm making it part of the main series as opposed to a bonus episode. The goal will be to get you to the point where you can look at a transaction and immediately have the instinct to know what to do the same way a professional bookkeeper would, taking you from the level of thinking to the level of knowing. The episode after that, we will return to our knowledge pyramid and learn about journaling and ledgers. If you have anything on your mind or you have any questions, go ahead and leave a comment. If you're interested in getting your books taken care of, I'd be happy to help. Visit vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you in episode 4. Welcome to episode 4 of Bookkeeping for Small Business Owners. In previous episodes, we learned the concepts behind bookkeeping. And in this episode, we're going to actually begin to apply those concepts. We'll be going through 13 of the most common transactions you'll find in a small business. And yes, there's going to be plenty of things you haven't learned before, which is why this is a mainline episode and not a bonus episode. That said, my goal with this episode is to get you to start looking at transactions the same way a professional bookkeeper would look at them. So, starting there, how do professional bookkeepers look at transactions? Professional bookkeepers look at transactions through the lens of debits and credits. Your instinct will be to try and find which accounts are debited and which accounts are credited right away. For example, in episode 3, Cookies Galore received $200 in cash for their cookies. A professional bookkeeper looks at that and immediately sees it as debit cash $200 and credit sales revenue $200. In this episode, we'll cover transactions in the following format so that you can start thinking like a professional bookkeeper. I'll start by giving the transaction and all of its relevant details. Then I'll show you how a professional bookkeeper breaks it down, which is how I want you to start looking at transactions going forward. Then I'll explain anything necessary. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. One last thing before we start. It's finally time to learn the difference between cash basis accounting and accrual basis accounting. That difference being timing. Under accrual basis, you record income when the money is earned, even if the money hasn't moved yet. Likewise, you record expenses when the money is owed, even if that money hasn't moved yet. The most typical example of this is when a business invoices someone or gets a bill. Under accrual, a business would record the invoice as income despite not receiving any money. Under accrual, a business would record that invoice as income despite not receiving any cash yet. And likewise, they would record any bills as expenses despite not paying out any money yet. Under a cash basis, you only record a transaction when the money actually moves. If you receive a bill or send an invoice, you don't record it at all in the bookkeeping. You wait until the invoice or bill is paid. In other words, you record transactions when the money is actually spent, or when cash actually moves, thus cash basis. To recap, accrual basis records transactions when they're earned. Cash basis records transactions when the money moves. All right, back to the episode. A few notes about the transactions before we jump in. We will be using cash basis for these. All of the businesses and transactions in these examples are made up. And of course, I highly recommend that you pause and try to figure out the answer before I give it for these examples. All right, let's get started with an easy one. Transaction number 1. Luke's Consulting LLC receives $400 in cash for services provided. First, let's look at it the way a professional bookkeeper would. The acronym I'm about to go over is something I made up, but it's a good breakdown of a professional's thought process. So, the thought process is this. MAC, M-A-C. This stands for money, accounts, and then change. For every transaction, you look for the money, then you see what account goes with that money, and then you make the change. Let's try out MAC for this transaction. Luke's Consulting LLC receives $400 in cash for services provided. Money, $400. Accounts, cash and service revenue. Change. Debit cash, $400. Credit service revenue, $400. Pretty straightforward. The accounts are explicitly stated, cash in exchange for a service. We know that cash is on the left-hand side of the accounting equation, and thus has a debit balance. Likewise, service revenue adds to owner's equity, which is on the right side and has a credit balance. Therefore, the correct bookkeeping is debiting cash $400 and crediting service revenue $400. And don't worry, I won't over-explain the other transactions in this episode. That said, as with all learning, you'll start off slow, but the more you practice, the less thinking you'll need to do and the faster you'll get. And eventually, you'll feel like you can do transactions almost instantly. Transaction number 2. Bob's Cleaning Company purchases a new vacuum for $200. Let's use MAC. Money, $200. Accounts, equipment expense and cash. Change. Debit equipment expense, $200. Credit cash, $200. As you probably realized at this point, the most challenging part of recording transactions is determining what the correct accounts are. Just remember, think about where the account might land on the accounting equation. Crediting cash is easy here, but how do we know the vacuum is an equipment expense? This one's a little trickier. We know if a business owns something with lasting value, meaning it will last longer than a year, it should be considered an asset. Why is the vacuum an equipment expense if the vacuum seems like it will last more than a year? The answer is simple. If a potential asset is less than $2,500, per IRS rules, it can be expensed rather than turned into an asset. It's worth noting that you could also label it an asset because of its lasting value, but it's more common to simply expense items like this upfront under cash basis. We touched on this last episode when talking about fixed assets, if you remember. And one more thing, your business does need a written policy acknowledging the IRS's $2,500 limit. Therefore, all of that said, even though the vacuum has lasting value and is something the business owns, it can be expensed because it's worth less than $2,500. We call it an equipment expense because that's the most precise description of it. The name of the account doesn't need to be perfect, as long as it's reasonable. What needs to be perfect is where it fits on the accounting equation. There are plentiful resources online for helping people determine the correct account for a transaction. If you use one of these resources, just make sure it's trustworthy. Transaction number 3. A patron at a bar owes $40 on their tab. They pay it down $20. MAC. Money, $40 and $20. Accounts, cash and sales revenue. Change. Debit cash $20 and credit sales revenue $20. Like we talked about earlier, under cash basis, we only record transactions when the money moves. We don't record anything about the $40 tab, only the $20 in income that was received for the patron paying down their tab. Transaction number 4. A therapist receives a $100 payment from a client's insurance company for a session completed in the past. MAC. Money, $100. Accounts, cash and service revenue. Change. Debit cash, $100. Credit service revenue, $100. This transaction is a reimbursement by an insurance company. Even though the client didn't pay for the session themselves, the bookkeeping is similar to as if they had. Oftentimes there will be a copay. The copay and the reimbursement, of course, would be two separate transactions. Transaction number 5. A lawyer purchases toothpaste for his children for $8. MAC. Money, $8. Accounts, owner's draw into cash. Change. Debit owner's draw $8 and credit cash $8. This is, of course, a little bit of a trick question. As we discussed in episode 3, only things that are both ordinary and necessary for a business can be expensed from the business. It's important for kids to have toothpaste, of course, but it's not necessary for the lawyer's business. This is a personal expense. So, what happens when you use business money for personal use? For tax purposes, this is considered a draw. It's a subtraction from owner's equity on the accounting equation that doesn't reduce taxes. In other words, a draw is the business owner taking some of their claim out of the business. Transaction number 6. A professional renews their license for $80 to continue legally working. MAC. Money, $80. Accounts, license expense and cash. Change, debit license expense $80, credit cash $80. And of course, a professional that requires a license to do business can expense that licensing fee. The next 4 transactions will be about the same business trip this person took. Typically, these transactions would happen sporadically over the course of the trip, but for the sake of simplicity, we'll say that each transaction type was paid all at once, just so that we can do this reasonably for the examples. Transaction number 7. Sarah runs a small marketing agency. She attends a 3-day marketing conference to improve her skills and network. Over the course of the trip, she spent $180 on meals, which she pays off all at once. MAC. Money, $180. Accounts, meal expense and cash. Change, debit meal expense $180, credit cash $180. As briefly mentioned in episode 3, meals are a very strict and unique expense for a business. A business can only write off a meal when that meal is explicitly to advance the business. This marketing conference works because Sarah can argue she would only acquire these marketing skills from this conference and that these skills are necessary for her success in business. If Sarah had just casually eaten with her friends, she wouldn't be able to write off the meal expense. Once a meal expense has met the strict standard, then it is subject to another limitation. That being that on her taxes, only 50% of the meal can be expensed. You'll notice though, we debited the entire $180 expense. In the bookkeeping, we record the full amount, so we know how much of an expense the meals were to her business specifically. During tax time, a CPA would look at the full amount spent on business meals and then take 50% of that for tax purposes. Transaction number 8. Sarah spent $900 on hotel rooms for the event and paid it off all at once. MAC. Money, $900. Accounts, lodging expense and cash. Change. Debit lodging expense, $900. And credit cash, $900. Lodging expense is a good catch-all for the various lodging and hotel costs you might acquire while traveling or on a business trip. Hotel is another expense that works, as long as you capture the general idea that this is an expense for staying somewhere outside of your normal home, for obviously explicitly business purposes. Transaction number 9. Sarah spends $200 for an airplane ticket to the event. MAC. Money, $200. Accounts, travel expense, and cash. Change. Debit travel expense, $200. Credit cash, $200. Typically, any costs associated with getting to the location can be expensed under travel expense. If she used her own vehicle and reimburses herself, the accounts would also be the same. Transaction number 10. Sarah purchases tickets to the event for $400. MAC. Money, $400. Accounts, professional development, and cash. Change. Debit professional development, $400, and credit cash, $400. The event itself is for professional development. So rather than a generic ticket expense or anything like that, we specifically label the purchase as professional development. Education and training expense would also be another good name for this. Transaction number 11. A construction company purchases a heavy-duty work truck for $50,000. MAC. Money, $50,000. Accounts, vehicles, and cash. Change. Debit vehicles, $50,000. Credit cash, $50,000. We've covered a number of expenses so far, but as we learned in episode 3, there are a handful of assets that can be purchased under cash basis. If you remember in transaction 2, we expensed the vacuum because although it had lasting value, its cost was under $2,500. The work truck in this example, though, is well over the $2,500 capitalization limit and should therefore be categorized as a fixed asset. Transaction number 12. A restaurant takes out a $100,000 loan with 5% interest. MAC. Money, $100,000. Accounts, loans payable and cash. Change. Debit cash, $100,000. Credit loans payable, $100,000. Loan amounts are recorded at their full amounts as a liability. And the cash from the loan is, of course, recorded as cash. It's also common to label the loans based on how long they're going to last. For example, a short-term loan being under a year, or a long-term loan being a loan that'll last longer than a year. And of course, if it's a short-term loan, that would be considered a current liability. And if it's a long-term loan, that would be considered a long-term liability. Transaction number 13. The restaurant makes a $2,000 payment on their loan. $1,600 is towards principal and $400 is towards interest. MAC. Money. $2,000, $1,600, and $400. Accounts. Loans payable, interest expense, and cash. Change. Debit loans payable, $1,600. Debit interest expense, $400. Credit cash, $2,000. This is an example of a split transaction, meaning one cash transaction affects multiple accounts at the same time. In this case, the cash was used to pay down a loan and its accompanying interest. And just like that, that's episode 4. The main purpose of this episode was to have you start looking at transactions the way a professional bookkeeper would, specifically through the lens of the MAC acronym, which of course stands for Money, Accounts, Change. In addition to that, I wanted to cover 13 of some of the most common transactions you'll find in a small business. Up to now, we've learned the basics of bookkeeping and how to correctly record a transaction. In episode 5, which is the next episode, we'll learn where to log these transactions, how to officially keep track of how money flows through a business, and then what we do with that information. In other words, we'll finally learn what the books are in the word bookkeeping, and then what we do with those books. If you have anything on your mind or any questions, please leave a comment. If you're interested in getting your books taken care of, contact me at vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you next episode. Welcome to episode 5 of Bookkeeping for Small Business Owners. In this episode, we will officially learn how to record transactions, as well as what to do with those recordings once we have them written down. Specifically, we're going to talk about financial statements, as well as the books in the word bookkeeping, those being the general journal and the general ledger. Today's episode will also cover the late core knowledge layer of our pyramid of knowledge. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. Up to this point, you've learned about the what, why, and most recently how of bookkeeping. Now let's learn the where of bookkeeping. Where do we put these transactions that we've recorded? In order to track how money flows through a business needs a centralized place to record all of their transactions, somewhere to officially recognize the transactions happened and to properly organize them. These centralized places are called the general journal and the general ledger. As mentioned earlier, in the word bookkeeping, these are the books that are being kept. You can think of the general journal and general ledger as the heart of a business's bookkeeping. Let's start with the general journal. The purpose of the general journal is simple. It's to keep a full and accurate official record of a business's transactions. The general journal does this by being where transactions are recorded in detail for the first time. This is why the general journal is also known as the book of original entry. So far, we've only talked about recording the account, debits, and credits of a transaction. To correctly journal a transaction, though, 2 more details are needed, making 5 in total. The 2 new details are date, the date the transaction happened, and description, why the transaction happened. So, in order to properly track how money flows through a business, we need to record transactions to the general journal. To properly journal a transaction, we need 5 details: the date, the account, the debits, the credits, and the description. It's worth noting that a 6th detail, called the journal reference number, is also used in accounting, but isn't universal in small businesses, so we'll stick to the 5 we just learned. All that said, once a transaction is journaled, it becomes a part of the official accounting records for the business, which will be used for taxes and other forms of legal compliance. Where a transaction is located in the general journal is referred to as its journal entry. The next question is then, where do I find the general journal for my business? If I start a business, how do I get my hands on a general journal? In a modern business, accounting software like QuickBooks Online will have a built-in general journal, which is where you would find it. If you don't use an accounting software, though, you can use a program like Excel, or you can quite literally just crack open a notebook and start journaling your transactions on paper. So, how do you properly journal a transaction? It's exactly the same way we've been doing transactions up to this point, except we format it properly and add a date and description. Different businesses will have different rules for their journal entries, but generally, they will look like this. Let's do an example. Transaction number 1. On August 14th, 2025, Cookies Galore spent $24 in cash to purchase a stack of printer paper. MAC. Money, $24. Accounts, supplies, expense, and cash. Change, debit supplies expense, $24, and credit cash, $24. Now, let's do the journal entry. I'll use Excel for this example. First, write out 4 columns: the date, the account, the debits, and the credits. Always start with the date. It's good practice to write out the full date. Here, this is 08/14/2025. After adding the date, we then add our accounts with their change. Very important. Always start with the debits and then do the credits. Left before right, like a reading order. In this case, we debit supplies expense $24. The debit account is always entered without any indents or spacing. Then we enter the debit in the left column, because debits are always left. Then we enter the credit. Always indent the credit to make it easy to read. On paper, this is about a ½ inch into your notebook, and on a computer, you can just press tab or press the spacebar 4 times. Then we enter the credit in the right column, because credits are, of course, always on the right. The description goes on a line below the debits and credits, under the accounts column, and doesn't have an indent, just like the debit. And there you have it, a complete journal entry. Since there are a lot of formatting rules, let's journal one more transaction just to reinforce it. Transaction number 2. On August 19th, 2025, Cookies Galore took out a $10,000 loan from the bank for operating expenses. MAC. Money, $10,000. Accounts, cash and loans payable. Change. Debit cash, $10,000. Credit loans payable, $10,000. Journal entry. Date. August 19th, 2025. Debits. We put cash and then the amount. Credits. We indent and then we put the credit amount. Finally, the description, which does not have an indent. And just like that, that wraps up our section on the general journal. Once again, the general journal is where we officially record our transactions, in detail for the first time, so that we can have a full and accurate record of the flow of money in the business. In other words, every time you have a transaction, you write it in the journal to keep track of it. If you want more practice, I encourage you to look at some of the transactions in your business and then journal them manually. Let us now turn to the general ledger. Previously, we learned that transactions change account balances. We also learned that this change in account balances is how the flow of money is tracked in a business. Well, if the official way to record a transaction is by journaling it into the general journal, the official way to change an account balance is to post those journal entries to the general ledger. In other words, the purpose of the general ledger is to track every account and their associated balances. So, how does the general ledger work? In short, every time you journal a transaction, you then go to the general ledger and update the accounts that were changed in that transaction. For example, if you have a transaction where you debit cash $200 and credit sales revenue $200, you would journal that, then head over to the general ledger and update both of those accounts, debiting cash and crediting sales revenue balances by $200. In fact, that's how the general ledger works. It keeps track of every account in the business, the changes in these accounts, and the totals for these accounts. The process of transferring the journal entry into the general ledger is called posting. In other words, when a new transaction happens in your business, you first journal that transaction and then post that journal entry to the general ledger. As you might have guessed, this entry into the general ledger is called a ledger entry. The ledger entry includes all of the information from the journal entry and acts as a sort of archive as well as a running balance. Let's do an example using transaction number 2 from earlier. Recall that for transaction 2, we debited cash $10,000 and credited loans payable $10,000. In order to post it to the general ledger, we would open our general ledger and find the next available line to write on. Once there, we fill in the line with the date, account, description, debit, or credit, and then the running total. If you like, you can create subledgers specifically for each account in the business. In this case, though, we're only going to use a general ledger. To post transaction number 2, we open the ledger and fill in the relevant details, starting with the debit and then the credit. It'll look like this. Now, let's say there was a $1,000 payment on September 24th, 2025 that was journaled separately. $1,000 in cash was spent to pay off $100 in interest and $900 from the loan. Now, let's say there was a $1,000 payment on September 24th, 2025 that was journaled separately. $1,000 in cash was spent to pay off $100 in interest as well as $900 off the loan. Let's post it. Notice how the total is updated. If it's unclear whether the running total is a debit or a credit, just remember that the running total amounts are shown in the normal balance for that account. Likewise, just remember, if the general ledger is ever hard to read, you can simply create a T-chart to get a visual understanding of any particular account. All right, believe it or not, after journaling your transactions and then posting them to the general ledger, you've completed the basic bookkeeping process. The gist of bookkeeping is looking into the bank and credit cards attached to your business, and then journaling and posting every transaction your business has. We still need to cover what you do with your bookkeeping, as well as how to properly do the full bookkeeping process from start to finish, but by knowing how to categorize and post your transactions, you've learned the basics of bookkeeping. Bookkeeping for your business, or as a service for someone else, doesn't end there though. If you remember in episode 1, we discussed why a business needs bookkeeping. There were a number of valuable reasons, but the most important reason was legal compliance. In order to be legally compliant as a small business owner, you need to produce financial statements. Financial statements report financial activity for a period. Financial statements are legally necessary because the law generally requires what's called adequate books and records, in addition to, of course, taxes. In short, financial statements turn your bookkeeping into useful information. There are a variety of financial statements that can be produced, but the income statement, sometimes called the profit and loss or the P&L, is the most crucial, as it provides the tax and regulatory information required for compliance. The next two most important statements after the income statement are the balance sheet and the statement of cash flows. Financial statements are standardized, so if you want to see a full list of options for financial statements, I encourage you to look up authoritative sources like the SEC. Before going further, let's recap the bookkeeping process so far. By the end of this course, we'll have a complete and comprehensive process, but for now, let's go through what you know so far. We know that bookkeeping is keeping track of how money flows through a business. We track the flow of money by recording transactions and updating accounts. We record transactions by correctly journaling them into the general journal. We update accounts by posting these journal entries into the general ledger. Then, we use the information from the general journal and general ledger to create financial statements. Business owners then use these financial statements to make decisions and stay legally compliant. Financial statements are the end goal of bookkeeping. This then raises the question, how do we create financial statements? The purpose of a financial statement is to turn bookkeeping data into useful information. To create a financial statement, we need to figure out what useful information we want. Then we gather that information from our general journal and general ledger to create a report. Now is a good time to point out the differences between creating a statement for a small business like yours and creating statements for public corporations and businesses making over $27 million per year, which we'll call large businesses. The key difference between creating financial statements for a small business compared to a large business is that large businesses are required by law to use accrual accounting and to follow what are called GAAP principles when they create their financial statements. As a small business owner, though, the requirements are significantly less stringent, as you only need to report to the IRS and not any major investors or the public at large. That said, as a small business owner, you'll still format your financial statements similarly to large businesses. You're just required to turn in less information. And yes, we will learn how to make statements that fulfill these requirements. So, with this long-winded introduction out of the way, let's learn how to create a financial statement. There isn't a perfect step-by-step process for creating financial statements because each of them requires different information. If I had to give a broad overview, though, the process would be this. Step 1. Determine which statement you want to create. Step 2. Gather the relevant information. Step 3. Compile this information into a statement. And Step 4. Finalize the statement and ensure everything is accurate. Step 1 is determining which statements you want to create. To figure this out, you need to know what information you're looking for. So, what information are we looking for? If you want to know how cash heavy or light you are, you would check the cash flow statement. If you want to see how owner's equity changed, you would look at the statement of retained earnings. As a small business owner, though, for tax purposes, you only need your revenue, expenses, and net income. In order to find these items, you need to create an income statement, which is the document I mentioned earlier, also called a P&L or profit and loss. Let's continue by focusing on creating an income statement specifically. So, for this example, we're looking for revenues, expenses, and net income. And to get that, we're going to create an income statement. Step 2. Step 2 in creating a financial statement is gathering the relevant information. To get the relevant information, you first need to know what each statement requires. You can find full statement requirements by checking authoritative sources like the SEC or FASB. Let's go over what the income statement requires. If you remember the accounting equation, assets equal liabilities plus owner's equity, you'll remember that revenues and expenses were subcategories of owner's equity. The purpose of the income statement is to subtract expenses from revenues to determine if there's an increase or decrease in the owner's equity for that period of time. Therefore, the relevant information for the income statement is the following: the time period, the revenue earned during that time period, and the expenses spent during that time period. Let's say we want to create an income statement for the month of August in 2025. Once we know the time period, we then collect all of the revenue and expense ledger entries from August 2025. Doing this is fairly straightforward. We just open our general ledger, start on August 1st, 2025, and then write down in a separate area all of the entries for revenues and expenses in the month of August through August 31st. This is part of what's called a trial balance, which we'll cover fully in episode 6. So after we've gathered all of this information, we move to step 3. Step 3, compile the information into a statement. We know the purpose of an income statement is to identify all revenues and expenses for a business for a period of time, so that we can ultimately determine net income. Net income is, of course, determined by subtracting expenses from revenues. So to put this statement together, with the correct format, we would simply create 3 sections. At the top, a section for revenue, below that, a section for expenses, and below that, a line for net income. After we finish putting the statement together, we go to step 4. Step 4, finalize the statement and make sure everything is accurate. After creating a statement, it's always good practice to look it over line by line and make sure everything is correct. Truth be told, there isn't a universal system for double checking, but here's a brief list of things to look over just to feel out if everything is correct. Dates. Make sure the period of time is correct. Format. Make sure it's easy to understand and that there's nothing throwing off the readability. Numbers. Make sure the numbers all sound right. You should have an idea of what the ballpark ranges for the various categories should be, so make sure everything fits and, of course, make sure everything is accurate. Ledger entries. It never hurts to skim over the ledger entries that make up the statement one last time just to make sure that every single one of them is on the statement and you didn't add or subtract any unnecessarily. All right, once you've reviewed the statement, finalize it by putting it in a shareable format, like a PDF if it's online, or a folder if it's physical. Then, if you need it for anything, you can easily send it to wherever it needs to go. With that, you now have an understanding of how to create financial statements. One more time, the steps are: Step 1, determine which statement you want to create. Step 2, gather the relevant information. Step 3, compile this information into a statement. And Step 4, finalize the statement and ensure everything is accurate. All right, that wraps up today's episode. We learned about the books in bookkeeping, which are the general journal and general ledger, as well as what to do with the information in them, by learning how to create financial statements. Next episode, we reach the finish line. We'll round out the crash course by going over the capstone of our pyramid, which includes both the accounting cycle and the bookkeeping cycle. That said, if you have anything on your mind or you have any questions, go ahead and leave a comment. If you're interested in getting your books taken care of, I'd be happy to help. Visit vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you in episode 6. Welcome to episode 6 of Bookkeeping for Small Business Owners. This will be our final episode, and we're going to cover the capstone of our pyramid of knowledge, which includes the accounting cycle and the bookkeeping cycle. After that, we will finish off our series by putting everything together with one final grand example. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. At this point in the series, we've covered all the fundamentals of bookkeeping. You know what it is, how to do it by recording transactions and updating the books, and then what to do with that information by creating financial statements. These financial statements, of course, being the end goal of bookkeeping. So, that being said, it's time to put it all together. First, we'll learn the official accounting process, called the accounting cycle, and then we'll learn the full bookkeeping process, called the bookkeeping cycle, which will then complete the course. Important note, you don't need to learn the full accounting cycle. You do need to be familiar with it for the bookkeeping cycle, though. Don't worry, though, I have summarized some parts down so that you still get the full picture of the accounting cycle, but we're able to be efficient with our time. So, with that, let's get started. What is the accounting cycle, and how do you use it? The accounting cycle is the standard 8-step process that takes an accountant from disorganization to fully updated accounting. The steps are as follows. 1. Identify transactions. 2. Record transactions to the general journal. 3. Post journal entries to the general ledger. 4. Create an unadjusted trial balance. 5. Make any adjusting entries. 6. Create an adjusted trial balance. 7. Create financial statements. And 8. Close the books. Many of these steps may seem familiar because, as mentioned in the past, the bookkeeping cycle is actually part of the accounting cycle. All that said, let's start with step 1. Step 1. Identify transactions. Up to this point, we've talked about recording transactions, but haven't really touched on where these transactions come from. We've just been using made-up examples. So where does a business find the transactions it needs for bookkeeping? The answer is bank accounts and credit card accounts. When it comes to bookkeeping and accounting, you find every bank and credit card tied to the business and then go line by line and collect the transactions. You also need to collect all relevant statements and documents, like loan statements, that might be necessary to help explain these transactions. Step 2 and Step 3. Record transactions in the general journal and then post them to the general ledger. We, of course, covered this last episode in episode 5, so review that if you wish. Step 4. Create an unadjusted trial balance. What is a trial balance? A trial balance is just every general ledger account listed out next to its balance. When every ledger account is listed out like this, it'll show every debit and every credit total in the business. The purpose of a trial balance is to show that when you add up all the debits and all the credits, they should be equal. The reason they should be equal is because of the accounting equation. When you've listed these accounts out and you add them up and you see that total debits equal total credits, then you've created an unadjusted trial balance. By ensuring total debits equal total credits, you show that the books are balanced. In modern software, where you're likely to do your bookkeeping, trial balances will be done for you automatically. Step 5. Make any adjusting entries. In accrual, not cash basis, but in accrual bookkeeping, there are times when the timing and amounts of a transaction don't line up with what actually happened in the bank and credit card accounts. When this is the case, adjusting entries need to be made. Since we're learning cash basis, we don't need to worry about this step. Step 6. Create an adjusted trial balance. Likewise, since we're cash basis, we don't need to adjust anything, and so we can skip this step as well. Step 7. Create financial statements. After making sure the books are balanced with the trial balance, you then create financial statements, which is something we covered last episode in episode 5. Step 8. Close the books. If you recall the time period principle from episode 1, you know that accounting is done over periods of time, whether annually, monthly, quarterly, and so forth. When one of these periods of time ends, the books must be closed. This is so the information can't be changed after the fact, and so that a new period can start fresh. Closing the books can be complicated, but for a cash basis small business, you more or less just need to bring the expense and revenue accounts down to zero. The reason we bring them down to zero is so that we have a clean slate so we can have a fresh profit and loss for the next period. Much like trial balances, modern accounting software will close the books for you. But just for the sake of learning how to do it properly, let's figure out how to close the books. To zero out the revenue and expense accounts, go to your general ledger for that time period and list out every revenue and every expense account used in that period, as well as their associated balance for that period. In some ways, this will look very similar to an income statement. We'll use the balances from episode 5. If you recall the accounting equation, you'll know that revenues and expenses are both subcategories of owner's equity. Closing out the revenue and expense accounts involves transferring their balances to the retained earnings account for that period. We transfer the retained earnings to, as you might imagine, keep track of what the owner has earned or lost in the business over time. For each of the listed revenue accounts, debit the account for their period balance and credit that balance to an account called retained earnings. For example, for hypothetical revenue number 1, we would debit it for its full amount of $850 and credit retained earnings for that amount, zeroing out hypothetical revenue number 1 and updating retained earnings. Remember that retained earnings is an owner's equity account and therefore a credit normal balance. Next, for each expense account used in that period, credit its final balance and to debit that balance to retained earnings. For example, if hypothetical expense number 1 had a $120 balance, you would credit hypothetical expense number 1 for $120 and debit retained earnings $120. For our example, we'll repeat this until every expense and revenue account is zeroed out. At the end, you can see near the bottom that our retained earnings is $790. As highlighted earlier, by closing revenue and expense accounts for the period into retained earnings, you add that period's net income or subtract that period's net loss from owner's equity. After doing this, your books are prepared for the new period and you can literally close your books if you're doing physically or digitally if you're doing them with software. Alright, that's the accounting cycle. That's the full cycle an accountant would go through if they were tasked with doing the accounting for a particular business. This course, however, is about bookkeeping. So now that you've been introduced to the accounting cycle, we can now focus on what you really need to learn. It's finally time to learn the official start-to-finish process of bookkeeping, the bookkeeping cycle. The bookkeeping cycle is the full approach you will use when doing bookkeeping for your business or if tasked with doing the bookkeeping for another business. The bookkeeping cycle takes bookkeepers from disorganization to having fully updated books along with their accompanying financial statements. This isn't necessarily something you'll find in a textbook, so much as this is the way professional bookkeepers generally handle a client's books. The bookkeeping cycle consists of 5 steps. Step 1, set up the books. Step 2, categorize transactions. Step 3, reconcile accounts. Step 4, create financial statements. And Step 5, close the books. Step 1, set up the books. Setting up the books can differ a bit depending on where you or your client keep their books. In 2025, the vast majority of books are done in accounting softwares like QuickBooks Online. That said, the setup will be very similar regardless of where they're kept. Let's break down Step 1 into a series of sub-steps. Step 1.1. Identify all of the bank and credit card accounts used in the business. As you know, in order to do bookkeeping, you need access to the business's transactions. And you get access to these transactions by looking into the bank and credit card accounts. You identify the accounts with 3 details: the name of the company, the type of account it is, and the last 4 digits. For example, Chase Business Checking $61.74. American Express credit card $73.68, and so forth. Step 1.2, get transaction feeds for these accounts. In modern software, you would simply connect the bank and credit card accounts with a service called Plaid and get a live transaction feed. If that's not possible, then you would need to either log into the account itself and look at the feed on their website, or get a copy of the account statement whenever it's released. Banks typically issue their bank statements at the end of the month, and credit cards will typically vary within the month itself, usually around the middle. Step 1.3, create a general ledger and a general journal. If you're using an accounting software, these are generated for you. If you're not using a software, you can pull out some notebooks and start writing things out by hand. Or you can open up Excel or an Excel equivalent and create a ledger and journal from there. For the journal, you just need a way to track each transaction with the 5 details we discussed in episode 5. And for the general ledger, you need a centralized location to transfer these entries to. Step 1.4, create a chart of accounts. After getting access to the bank and credit card account feeds, you can start to create a list of ledger accounts to categorize the transactions into. This will be a basic list made up of accounts like service revenue, office supplies, and so forth. You'll create more specific accounts as you do the bookkeeping, but it's good to have a basic list before starting. As a quick tip, I also recommend giving each account a number so that the chart of accounts is easy to search through later. Step 1.5. The final step of setting up the books is customizing the books for your business. This means writing down important details that are specific to your business. Things like the name of your business, whether you're cash basis or accrual basis, what the fiscal start of the year is, opening balances for any accounts, and of course what the fiscal end of the year is. After adding this information, you've completed setting up the books and thus have finished step 1 of the bookkeeping cycle. Once again, the sub-steps to setting up the books are: identify the accounts used in the business, get access to their transaction feeds, create a general ledger and a general journal, create a chart of accounts, and customize the books. Step 2 of the bookkeeping cycle, categorize transactions. Categorizing transactions makes up the bulk of bookkeeping work. In fact, this is where you'll apply most of what you've learned in this course. If you remember the acronym MAC, M-A-C, as well as the other 2 journaling details, date and description, this is the part of the cycle where you'll begin to actually record transactions with this information. Modern software like QuickBooks Online helps save a lot of time, in part, by automating much of this categorization process. Whether you have an accounting software or not, the workflow will still be the same. This workflow will take us from completely uncategorized to completely categorized in 3 sub-steps. Step 2.1. Determine the start date of the bookkeeping. Typically, the start date for bookkeeping will be the last time the books were reconciled. If the books are new or have never been reconciled, you'll likely start from the last tax return. For example, let's say today is September 1st. If you last reconciled your books for the month of April, then your start date would be May 1st. Why is this? We'll talk about reconciliation soon. A reconciliation is how bookkeepers verify the completion of books for a time period. If the last reconciled month is April, that means the books are correct through the month of April and no further. This means that we start with the next day, May 1st. If there's no reconciliation, we use the tax return, because the tax return is the last time the business's books were verified to be complete. So, to determine the start date, we figure out when the books were last verified to be complete, and then we start the day after that. If there's absolutely nothing, then just start fresh on the first day of the period needed for taxes or legal compliance. In all likelihood, this is probably January 1st for those that need the entire calendar year. Step 2.2. Open the account feeds to the start date. After figuring out where to start, open all the accounts you connected to the business when setting up the books in step 1, go to the list of transactions, and go to the start date that we just decided in step 2.1. For example, let's say you have a Chase checking account and start on May 1st. If you have an accounting software, you would connect the bank to that software, sort by the date, and start with May 1st. If not, you would log into the bank account itself and either go to the feed and find May 1st, or download the bank statement and find May 1st there. Step 2.3. Go line by line and categorize each transaction. With the feed open to the start date, it's time to start categorizing. In an accounting software, you would simply select the first transaction for that day, click the drop-down menu, and then select the appropriate account for the transaction, which comes from the chart of accounts you created earlier, creating any new accounts as necessary. You would then categorize each transaction like this until you get to the present day. If you're bookkeeping for someone else, it's very likely you'll need to ask them about certain transactions. Other than that, the process is pretty straightforward. If you're not using an accounting software, you would need to manually write down each journal entry into the general journal that you prepared earlier, being sure to know each of the 5 details required for that journal entry. After each entry, you would then need to transfer it to the ledgers you prepared when you set up the books earlier as well. Repeat this for each transaction until you're current. Regardless of how you categorize the transactions, by the end of this step, every transaction from the start date to the present date will be categorized. Once again, the sub-steps are: determine the start date, go to the start date in the account feeds, and then go line by line and categorize each transaction. Step 3. Reconcile accounts. After categorizing every transaction, you now need to verify that the bookkeeping is complete for that period. You do this with a process called reconciliation. What is reconciliation? Reconciliation is ensuring the transactions in your books match the transactions in your bank and credit card accounts. That way, you know you didn't add or forget any transactions, and it helps verify the accuracy of the numbers in your books. Remember, your accounts will have the true numbers, and your goal is to make sure that your books are accurate to the accounts, but always defer to your bank and credit card accounts, which will have the accurate information. So, how do you reconcile your books? Let's once again break it down into sub-steps. Step 3.1. Gather bank and credit card statements. Each of the accounts in your business will issue statements at some point during the month. As mentioned before, bank statements typically occur at the end of the month, and credit card statements will vary, but will usually be towards the middle of the month. Reconciliation is largely comparing account statements to your books. So step 3.1 is downloading or printing off these statements. Step 3.2. Compare starting balances. For each bank and credit card account in your business, compare the beginning balance from their statements to the beginning balance in your books for the same starting date and the same account. If they're the same, move on to step 3.3. If the starting balances are different, that means something is off from the prior time period and you need to backtrack and apply the bookkeeping cycle to an earlier period. Now is a good time to emphasize one key detail. Your books are just a collection of all the transactions from your bank and credit card accounts. Therefore, after reconciling all of these accounts individually, your books as a whole are considered reconciled. The key detail I want to emphasize is this. When you reconcile your books, you're reconciling one bank or credit card account at a time until all of the accounts are reconciled. For example, if you reconcile Chase Business Checking 6174 from earlier, you would open the statement they issued and compare it to the transactions in your books from Chase Business Checking 6174. You then repeat this for each account until all the accounts are reconciled. That's what it means to reconcile the books. Step 3.3, match transactions. Start at the top of your bank or credit card statement and compare it line by line with your books. For each transaction on the statement, find it in your books and check it off. By the end, every transaction on the statement should be accounted for in the books. If there's any disparity, it will be with the books. Let's do some basic troubleshooting for any issues you might have. If your books have different amounts, update them with the bank amounts. If your books are missing transactions, add them to the books from the account statement. If your books have too many transactions, see if there's anything still processing in the bank or if those extra transactions landed in the next period rather than the period you're reconciling. If you still have too many transactions, defer to the statement and remove the extra transactions from your books. Step 3.4, verify the ending balances. After matching all the transactions and correcting any disparities, write down the end balances for the period from both the statement and your books to see if they're the same. If the opening balances are correct, everything is matched and corrected, and the end balances are the same, then you've successfully reconciled the books, and you can mark them reconciled for the period. Step 4. Create financial statements. After reconciling for the period, the next step of the bookkeeping cycle is creating financial statements. We covered creating financial statements in episode 5, so if you want to review the process, please revisit that episode. In short, reconciliation is needed to create reliable financial statements, which is why the steps are ordered in this particular way. Step 5. Close the books. When it comes to bookkeeping, there are two main reasons to close the books. 1. To prevent anyone from messing up the books later. And 2. To reset the revenue and expense accounts back to zero. Closing the books isn't always necessary when bookkeeping. If you're okay with carrying expenses and revenue balances into future periods, and you don't mind the risk of someone changing past transactions, then it's really only necessary to close the books at year-end for taxes. In accounting software, they typically close the books for you at the end of the year, or they make the process very easy to go through yourself. If you're doing your books manually, though, close the books the same way you would for the accounting cycle. In other words, you journal the amounts out of your revenue and expense accounts and into a retained earnings account. And that's it. After closing the books, you've completed the bookkeeping cycle. The typical yearly workflow for a bookkeeper ends up looking something like this. Start with step 1 and set up the books. Categorize the business's books with step 2 on a weekly basis. Reconcile and create statements at the beginning of every month for the previous month with steps 3 and 4. And then close the books with step 5 when desired or at the end of the year. And with that, let's put everything together with one final scenario. It's February 2025, and the owner of Cookies Galore wants to do their own bookkeeping. They've watched Bookkeeping for Small Business Owners and know enough to go through the bookkeeping cycle, which they plan on doing now. Seeing how much time and effort they can save by using an accounting software, they purchase a subscription to QuickBooks Online. They log into QuickBooks Online and customize their information and then connect all of their business, bank, and credit card accounts. QuickBooks Online automatically shows them their transaction feed in real time. After this, they go to the chart of accounts and set up the accounts they'll need. At this point, they've completed step 1. Since this is the first time they're doing their books, they don't have any reconciliations. So they decide the starting point will be their last tax return, which was December 31st, 2024. Therefore, they realize their starting point will be January 1st, 2025. QuickBooks uploaded all of their transactions from 2025 when the owner connected their accounts earlier. So, the owner scrolls to January 1st, 2025, and looks at the first transaction. With the owner's knowledge of bookkeeping, they begin to categorize each transaction to its proper account, solving any uncertainty by reflecting on their understanding of the accounting equation. After some time, they finish categorizing their transactions, finishing step 2. With their transactions caught up, they check to see if there are any account statements they can reconcile to. They see that all of their accounts issued statements on January 31st. They download the statements and go line by line and ensure everything is accurate and complete. After doing this, they mark their accounts reconciled to January 31st, finish step 3. Having reconciled through January, the owner of Cookies Galore creates a profit and loss statement and analyzes where they're doing well and where they could use improvement. After that, they stay on top of their bookkeeping and repeat steps 2, 3, and 4 every month, which allows them to have what they need for quarterly tax estimates, annual taxes, loans, regulations, and of course, decision making. At the end of the year, they close out their books for 2025, completing step 5 and completing the bookkeeping cycle. And that's it, folks. You successfully completed the course. In episode 1, I told you by the end of the course, you'd be able to confidently do your bookkeeping, have a professional understanding of bookkeeping, and with that professional understanding, be able to breeze through most, if not all, bookkeeping certification courses. Although this has been a crash course, and far shorter than something you'd find in a college or university, I feel comfortable saying that we covered everything you need to know to meet these criteria. That said, this is only a professional understanding. If you truly want to become a professional bookkeeper, or be at the level of a professional bookkeeper, you'll need to apply what you've learned here, which I fully encourage you to do. And with all that said, the course may be over, but I don't plan on going anywhere. If you have anything on your mind or any questions, go ahead and leave a comment. If you're interested in getting your books taken care of, I'd be happy to help. Go to vitalitybookkeeping.net. Otherwise, thank you for watching and have a great day.